So you're probably aware by now that so many people are talking about the S&P 500 being in a bull trap. And this is partly due to the Fed and their stimulus, and also partly just because of what Wall Street wants to do. In this video, we're going to examine what has happened over the last 148 years and try to piece together a bit of a better understanding of what might happen in the future. We'll see you on the other side. I couldn't help myself. I had to put in this meme. It's so true to what's happening right now. Crazy unemployment figures. And of course, what does the market do? It goes up. Hard to fight the Fed. Okay, so just before we get into the thick of this video, I'd like to just remind everybody, please like, comment, and subscribe to our videos. We're really trying to push to the next level on YouTube, and we'd love for you to become part of the trading community and possibly even join our Telegram group. So look at the links below to find out more information about that. All right, so here we have the S&P 500, and we can see the crash in terms of what's happened at the start of the year with the COVID outbreak, going down to a low of around 2200 just underneath, and then of course the recovery, or the miraculous bull recovery that we've seen in recent weeks, all the way up to 2900. We've mentioned this, it's between a 50 and 61.8 Fibonacci of the entire move down. It is looking quite bullish, and while many people are expecting it to of course go down again, it won't do so, generally speaking, until most people don't expect it. And that's why they call it a trap. Traps are traps for a reason. So let's jump straight into a few history lessons that we can learn. Okay, so here we have the S&P 500 inflation adjusted with a log scale over time. This is a great website, by the way, macrotrends.net. Good little area for you to potentially get some older charts, inflation adjusted and log scaled, so you can see different recessions in the past. So many people are aware that there's been some pretty serious recessions in the past. We can see the 2000 crash. We can also see the 2008 crash or the GFC. And of course, the one that everyone's trying to figure out whether this is a similar situation is the 1929 crash, which was very historic. I've actually got some numbers down here for the 1929. We can see the year coming into 1929, 37.8%. So 37.88% was the gain on the index for that year. That was followed by, not really a terrible year. I mean, 11.91% is not good, but it wasn't terrible. And that's because it was actually up and down. There was a great bull trap in the 1929 recession. And then, of course, 1930, 1931, 1932, absolutely terrible years, followed by some seriously green bullish years. So this crash was very different. The Fed did not step in over the 1929 crash, and it is always important to note that there wasn't as much stimulus as there is currently in the market, but very interesting to see that while the first year may not have been that bad, there was some serious volatility in that year that is not shown in the year-on-year figures. But it does show you something and what could potentially happen in the worst case scenario. So let's get rid of the log scale and the inflation adjusted scale and just consider if we'd invested money back in 1929. So if we'd invested some money, even inflation not adjusted, and we put into the index was effectively around 22 points in 1930, 22.79 points. Where is it right now? Of course, we're sitting up at around 2,800 points. So a massive change over this period of time. And we can see since pretty much around the 80s, when really Buffett also started growing a lot of his wealth, massive increases, very, very, very kind of like almost parabolic rise into the tech bust. We had the GFC bust and you had the tech bust. That kind of kept the S&P 500 down. One thing that's important to know, whenever you see an S&P 500, you remember it's the top 500 companies. If there is a crash, there is an argument to be made that the back-end companies are not going to survive the crash. And while indexes will rotate in and out, remember it takes time for these indexes to be rotated. So it can be upwards of 3 months to get rotated out of. So it can take some time for indexes to recover. And we'll talk about time recovery in just a few minutes. But since the GFC and since the pressing of quantitative easing by the Fed into the market, the US has had a parabolic rise in terms of their stock market very, 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 very swiftly over the last 12 years. And this is part, in fact, to it being an amazing time for some US companies and corporate profits, but also because of quantitative easing and the stimulus that's been pumped into the economies by the Fed. Let's take a look at some images of what's happened over the last 148 years and how we may learn from that. So here we have a chart of the last 148 years, the 11 stock market crashes of the S&P 500, or at least the most notable ones that went relatively deep. We can see there's quite a lot of variance in these, but there are some very interesting things that happen time and time again when it comes to these crashes. So first up, 1877. It's going to be very difficult for us to draw too many parallels here, but maximum loss, 33%. Years to break even from the negative 25% point. So when it hit negative 25%, remember a bear market is considered 20%. So negative 25% took 1.8 years to recover. 1893, 4 years to recover. 1903, 1.1 years to recover. 1.2, 1.5. Then there was, of course, the absolutely terrible one, which was 1929. Again, the one that a lot of people are putting parallels in. 15 years to recover. But the market did go down 82% over that period of time. So it makes sense that it took a while to recover. 1970, very quick recovery. 74, very quick. 87, relatively quick. And not relatively that deep, considering even what we've seen this time. But these are the ones I want to highlight. So I want to highlight 2008, and I also want to highlight 2001. And this is because these are the most recent ones, and these have very similar depths in terms of the maximum loss of the market. 2001, 42%. 2008, 49%. And look at the recoveries, very similar as well. So obviously GFC was arguably worse than the tech bust. Well, not even arguably, it pretty much was, because it was a real financial crisis across the global world. And we're in a global economy nowadays. 2001 was due to very, very bad evaluations. We've talked about that, talked about the Shiller Index, talked about evaluations of profit earnings. There were some insane evaluations in 2001. But if we take all of these figures together, a median of around 33% seems to be what you generally do see. That is what we've already seen once already in this crash of COVID-19. But it usually takes a long time for the market to recover. So 1.8 years on average. More importantly, the previous two have taken 4.1 and 4.8 years. So we usually expect when we're in a recession environment, it takes time for it to recover, and that the previous ones have been deeper. So if we're facing an unprecedented event, do we think that these markets could be deeper? It definitely could. And that's what we have to learn from history. History is a teacher for us to make potential informed decisions in the future. So let's bring up this second image that we've got here. And this is the idea that you've really got three choices during these market crashes of what you want to do. One is, of course, the dash for cash, or exiting stock positions or exiting investments and then going back into cash. The other one is, of course, to stick with stocks and do nothing approach, which is what a lot of people choose to do. They just basically hold on, hope they've got quality stocks or quality indexes, and it comes back eventually because of the nature of inflation and money. And then, of course, the double down. So invest additional money in the stock market, either as a lump sum or some kind of drip over time. So maybe adding a certain amount per month. And they're all very valid concepts. And let's have a look at how I guess they would have fed into the market. So this is assuming that at negative 25% on the stock markets, that effectively you would be looking at potentially either doing the dash for cash, get back in with extra money, or of course the do nothing approach. So let's highlight some key figures here. So the first one is, I think, the dash for cash. Look if you had exited the market, even at 25% down, how long it took you because of cash rates and because of things like that to get your money back. It took a very, very long time to get your money back. Very long time. 34 years. I mean, that's just terrible. More interestingly, though, if you dashed for cash during the last two crises, you would not have been able to recoup your losses effectively. So it would have taken a very long time for you to recoup your losses. Stocks, if you did nothing approach, 4.1, 4.8, and then of course in 1929, 15.2. So still very bad. These are definitely bad numbers, but important because they did happen and we need to realize that. The previous ones, 4 to 5 years. Obviously terrible if you'd invested at the highs, but there are ways to mitigate that loss. So in this scenario, the double down or drip feed, I've actually taken it from an article which I'll post down below, which you can read. It's a good little article and has these charts in it. And what they've basically done is they've done a study on effectively the equivalent of a share portfolio. So if you had, let's say, a share portfolio and at the 25% decline level, you decided that you would basically invest 5% of the portfolio's value at that point, and you would continue to invest 5% of the portfolio's value over the next years, then you would basically get back much faster. So you can see here, to get back to the pre-crash value, 3.3 years, and then 3.3 years. So it really makes you wonder why more people don't do this kind of concept. And of course, it's very scary. It's where Buffett comes in, and you hear about the idea of be fearful when others are greedy, and of course be greedy when others are fearful. But look at the difference that it makes to the 1929 crash if you had made this decision. Now, of course, to get back to pre-cash value plus the value of the additional investments, then it would take a little bit longer. And that's effectively saying this is probably the real number you want to look at, because you have invested more money. It's not just about getting back to the value, it's about getting to the value plus the money that you'd added in. So 4.3 years during the tech bust and 3.6 years during the 2008 financial crisis, 6.7 for the big crisis. But the numbers are significantly weighted to your favor if you had done something like this. So next time when you're considering the second wave or the second crash, which definitely could happen in this scenario, many people are talking about it, doesn't mean they're wrong. It just means the market's trying to trap them.